So as many of you know, like I'm always cost averaging, and lately I've been very aggressive in buying the S&P 500 because I believe this dip got kind of oversold against the earnings that we've been seeing thus far across the broader S&P 500, right? But on the side note, like, continuing to cost average in the broader market, I like to make these more selective bets on companies that have statistically grown at outpaced returns and continue to. And one of those, of course, has been Google, right? And Google just posted earnings, and my jaw is kind of on the floor because in line with Meta, they have now become a dividend company. And not only that, the numbers they posted were enough to revitalize the entire market in line with Microsoft as well. We're going to talk about Microsoft earnings, but you remember what volatility we experienced with Meta dropping 10% after blowing up numbers unlike anything we've seen in their history at this scale, where their net income was up over 100%. So I wasn't expecting a whole lot of gusto out of Google, but who really knew what was coming, considering Tesla, is up 6% today after, that insane, terrible earnings, and the stock was still able to go up, proving that the market is pure fugazi. Nobody knows whether we're coming or going. You just want to own really great brands over very long periods of time, or just own the broader S&P and never sell it, because these idiots that were fear-mongering literally a week ago, they just can't get it right. There's so many influencers. Everyone's so damn negative, so damn long. But here I am, buying and being aggressive, and it's working. It's funny. I probably have a good couple G's on my minor investment in Google. I wish I had a lot more, but hey, 10 G's US, it's up 12% after. We're making a good 1,200 USDs here or there, give or take. But take a look at this, because these numbers are shocking. And then we'll talk about the dividend, because revenue, my God, from $69.7 billion to $80 billion for what should be the slowest quarter of the year. Change in revenues were up 15%. Are you kidding me? God damn. To get these kind of growth rates at this scale is nuts. They've increased their margins by 32% thanks to layoffs, cost cutting. We've seen the very similar story coming out of many of the companies through this tougher market environment. But earnings per share, same deal, $1.17 to $1.89. From $15 billion to $23 billion for Q1 of all cents. Like, they were up $8+ billion in Q1. You know what the growth rate of net income is there? Like, it's disgusting. It's like insane. I don't know how Meta wasn't rallying, but I guess because their guidance came in a bit lower than expectation into the future. But even still, let's just kind of break this down by the actual networks here, because you got Google ads or YouTube ads and Google search and other. These two are by far the biggest contributing factors. YouTube continues to grow at an incredible clip from 6.6 billion to 8 billion. Google search obviously being the conglomerate that's at risk of AI, the likes of ChatGPT, the new competition of search, search platforms out there, but it doesn't seem to be making a difference because the company's still kicking ass and taking names. Google services total went from 61.9 billion to that 70.3. Cloud growing insane here, 7.4 billion to 9.5. Other bets continuing to go up. This would be in line with their self-driving technologies. And total revenue all bringing this together in something that is truly insane. Other than Google Network. Google Network was down slightly, and we'll see that with some of the other bets here as well when it comes to all their other bets was actually down slightly, which I found kind of interesting. And same with Google level activities, which I'm not sure exactly what that comes into play. But what's got people real giddy here is if you scroll down, we got the dividend program. Alphabet's board of directors today approved the initiation of a cash dividend program and declared a cash dividend of 20 cents per share. So you annualize that out over 4 quarters, you're looking at about 80 cents per share. If you take a look at the average share price today of $1.77, very small dividend, very, very small dividend, coming in line with the big tech companies though, Microsoft, Apple. This is great for the broader S&P though. This means that all these mega cap companies are going to be boosting you as a shareholder. If you just own the S&P, you're going to start getting more dividends here. At least the top holdings are going to be kicking out something real nice. On top of that, they also authorized the company to repurchase an additional $70 billion of its Class A and Class C shares in a manner deemed in the best interest of the company and its stockholders, taking into account the economic cost and prevailing market conditions. $70 billion in share buybacks. What's the Google stock current market cap today at $2 trillion? So again, the share buybacks are great, but at this scale, I mean, we'll be over $2 trillion by. This is great. I mean, this is whew, I was like blown away. Awesome, just beautiful, beautiful stuff. Anyways, that's Google, right? Let's talk about Microsoft here real quick because Microsoft's playing in the $3 trillion cap range. It's gonna be real neat to see what Apple posts, but it is also rallying here. I mean, we're seeing it up now. What is it at 4% in after hours? What's it doing on stock? It's pulling back a little bit. What are we doing here? Let's keep an eye. Microsoft is up 1.8%, so it's giving up some of the aftermarket gains. But let's just take a quick look. We'll take a peek here because their revenues came in at almost $6.2 billion, which is an increase of 17%. Operating income was up 23%. Okay, so net income was up only 20%. So, these are what normal numbers would look like without crazy cost cutting and doing all the stuff that Meta and Google are doing. Like they've done a lot of tactics because they've been throwing out so much capital, especially Meta, into Reality Labs and stuff. They were able to actualize a lot more net income against the back of also buying shares. Getting rid of some of those shares off the table also raised that net income. So, I mean, these are great numbers. I mean, we're talking about a company that's returning to diluted earnings per share growth of 20%, and their revenue is getting close to double-digit revenue. Like, this is so crazy. I'm starting to get the vibes that we're going back to what was the teens of the 2020s. Like, the 2020 teens, or the 2000 teens, from 2010 to 2020. What a beautiful time period for the market. Because as recognized, like, I always like doing this. If we go back to Microsoft revenue on, say, macro trends before we hop back into that, I'll have to backtrack a little bit there. But if you take a look at, like, revenue growth, like, I mean, look at this. So from, like, 2010 all the way basically to 2020, we've had mostly very consistent, with a few exceptions, but mostly very consistent, double-digit revenue growth. And that's for the same for most big tech companies. Like Amazon didn't even miss a heartbeat up till recently, right? I mean, the pandemic really took all these companies for a whirlwind, especially the current environment we're in, which was caused by the pandemic. Everything that we're dealing with now is caused by what happened in 2020, even though it's been 4 damn years already. It feels like it was yesterday. God, we're getting old, folks. We're getting old. That's why we got to keep investing, making sure that we can function in our retirement and be comfortable. But I mean, let's just take a deeper look here, because what I like looking at is what's causing a lot of the growth variance here. So percentage change on a year over year. We'll take a look at the gap, because again, Azure, their cloud computing service, up 31%. What's really intriguing to me is Xbox and services were up 62%, which I think only could come into play because of the acquisition, perhaps, of Blizzard. I mean, this is what happens, right? When you ever look at Microsoft, it's like a piston. It's like a car. It's got all these different pistons that are running the engine, right? And when one of those pistons start to get damaged, slows down, or isn't experiencing growth, they'll have some kind of fixation on it. And that's what I said about Xbox. You go back to prior earnings, and they weren't seeing a whole lot of growth in the gaming sector. So what do? They go look for acquisitions that can continue to propel growth, right? Let's take a look at here. We got something that's trading at 4%. So office, consumer products, and cloud services only grew at 4%. So this is now the new weaker part of the system. They need every part of the system growing at least in double digits. So you can always kind of focus on what they're going to be paying attention to next based on these pillars, these pistons that are running the motor. I always find Microsoft to be a really good exemplifier of this, because they always seem to shift focus to whatever's slowing. So either way, like, again, take a look at the S&P 500 here, folks. You can't listen to these clowns telling you not to buy and get fear-mongered into cash again. I mean, I'm going to probably buy more tomorrow. I've been buying S&P pretty aggressively here as of late, because I do like this dip, and I told you guys I don't think we're out of a bull run yet based on these earnings. There's going to be some extreme volatility, but I'm not ignoring this right now. This is just too juicy. Muy bien. I'll pass the question off to you. Let me know what you think in that comment section below.